Welcome to SproutMedia.com. It's another trading week, and that could mean more of the same. Will we get more insight into the tug of war between the bull and the bear? Well, joining me at the NASDAQ market site is Joel Litman, and he is the CEO and president of Valens Research. Joel, great to have you here today.
Thank you, Remy. Thanks.
Well, it's the beginning of another trading week, and we're seeing plenty of market volatility. So I want to start out by taking a look at Valens Research. I understand that it was founded in the wake of the financial crisis, and I get that you have a certain take on financial reporting. So what do you make of the earnings season so far?
The earnings season has been fantastic. I think when we look back on where the markets are, we will think that this was the best buying opportunity we would have had for the next 2 to 3 years. We've tested February 8 lows several times, and successfully a lot of strong hands and investors have come in, and I think earnings has a lot to do with it. I think once people realize just how high quality the earnings numbers are that are coming through, we are really setting up for a fantastic run for the rest of the year.
Mm-hmm. And while we're on the topic of earnings, we've been seeing some very interesting earnings calls so far. Without naming any companies, it does seem like this anxiety as well as frustration over companies might be reflected in some of the earnings calls based on questions we're getting from analysts. But does that tell you anything about what's happening in the broader market?
Yeah, it's interesting. You know, our focus at Valens is on getting a quality earnings number that's calculated on a uniform basis over time. Mm-hmm. And so one of the things we saw just recently is Berkshire Hathaway, which reported earnings something like $5 billion lower than last year. Now, Warren Buffett was quick to say, this is one of the reasons you can't focus on reported earnings. You have to look at the operating earnings numbers and a quality earnings number, and when you see that across the Berkshire business lines, you saw a great year. And so this is the issue we're looking at, is that over time, earnings has been, the as-reporting earnings number has been getting more and more conservative. The accounting rules are not the same rules that were in place 10 years or 20 years or 30 years ago. And so unfortunately, the earnings number can't be compared over time. It's not an apples-to-apples comparison, unless you create some uniformity, and that's what Valens has been doing, and that's why the signals we're looking at are different than the as-reported earnings numbers that you see every day.
Mm-hmm. And now that we've covered earnings, I do want to move on to what we're seeing in the macro space. So we've been getting a bunch of fundamentals, GDP, jobs report, but it really depends on what part of the reports you really look at, given that the bigger picture is okay for the time being. But we're seeing credit risks rising, and there are expectations of Fed rate hikes this year. So what do you make of the broader picture?
Yeah, the credit cycle, you know, someone once said you can't be a great equity investor if you're not a solid credit analyst, particularly in the macro. Credit cycles drive equity markets. And so credit has always been the canary in the coal mine in all developed markets for the last 100+ years. The credit outstanding right now, corporate credit debt in the U.S., is the highest amount we've ever measured, and that's what gives people concern. But as they say, it's not an inability to pay your debts that causes bankruptcies. It's an inability to refinance. And we're in one of the healthiest refinancing environments we've ever seen. The corporate debt head walls, meaning when the debt is due, is 2, 3, 4, 5 years out. Because of that, we have a very, very healthy credit cycle. We're in the middle of a fantastic setup, and that's very supportive of an equity bull continuing for another 2 to 3 years.
Okay. Well, now that we know your take on the tug of war between the bull and bear, I do want to bring you to the last question, and it's about value as well as risk. Now, you've addressed the question of whether you think, you know, we're at the end of a bull market or not. So in terms of value, where do you see value right now?
You know, value is, are you able to buy a stock that is going to outperform the performance that's embedded, right? So where do we see it? Across the board, using the uniform accounting, there's, I'd say there's 6 ideas that I'd mentioned, and all have the same quality, which is the as-reporting earnings number is much lower than the actual uniform earnings number, which is what the market prices stocks on. In all cases, the price to earnings on a as-reported basis looks high, but on a uniform basis is actually quite low. And so I'll name the companies that, you know, 3 are tech, and they're what they call bionic companies. There's two friends of mine, Miles Everson and John Sfiocla, talked about companies that are leveraging behavioral capital and cognitive capital and network capital. Facebook is one of them. I think the fall in price in Facebook is giving us a fantastic opportunity to get in a name that's going to be very strong for a while. I think Alphabet is another one. And then a third that's really been maximizing and doing things, and it looks like a bad company on as-reported earnings, but on uniform, it's a great company. It's Zillow Group. That's all three tech. If we want to talk three stocks that aren't tech, I'd mention one of my personal favorites, Planet Fitness, that's been doing great in the low-cost environment for gyms and fitness centers. Second, Winnebago, it's moving to campers. And again, the uniform accounting is lining up that I think the market doesn't realize how strong this company's earnings can be over the next couple of years. And finally, D.R. Horton, or DHI Homes, which I think it's moving to single-family homes, and the age wave really backs up why it's going to do so well. And so those are, I think, 6 ideas that are really poised well for what we're going to see over the next couple of weeks.
Okay, Joel, well, thank you so much for joining me today, and thanks for all your insight.
Thank you, Remy. I appreciate it.
Thank you.